All right. Good morning, everybody. We're back. All right. So we're still maintaining that range on crude oil and in Brent. It's certainly getting tighter and tighter. This is going to be making a move soon. There's no other way around it. It has to move soon. So, right, it's the way things go with the pattern. When you have a wedge, you very, very rarely ever see price make it all the way into the final apex. Generally speaking, around 65 to maybe 80% of the range gets taken out or of the wedge gets taken out, and then we get that price move. So this is going to be breaking to the upside or the downside, but I'm on a daily chart. So, it doesn't have to happen today, but it's certainly coming soon. If you've been maintaining iron condors on this thing, you want to think about wrapping it up, right? You're running out of time. So Asia did close up on the day, but the recovery that we started to see in in the futures market didn't get the recovery didn't stick. And as it started to fade back out, Asia had already closed for the day, so we didn't see it come back down and break that low. Europe, on the other hand, two sides on this. We got a pretty equal candle. Inside day breakout to the downside. It tried to recover, couldn't even sustain 50% of the previous bar, and back down we go today. We're not at the lows, but we're certainly not back inside yesterday's price. So got to kind of see how it continues to bleed. You want to continue to keep your eye out on redemptions. I had a lot of people contact me over the last 3 days, and by far the most dominant question was, I don't trust my broker. Should I pull my money out? Well, I mean, I know that's a very small sample, but I teach this stuff, and even people that have kind of a clue are still freaking out and are talking about pulling their funds out of their broker. You know how you do that, right? You have to sell what you're holding and then pull your funds out of your broker. So, knee-jerk reaction seems to be that a lot of people who don't really know what they're doing do know that they don't like their risk that they're holding and they want to dump everything they own. Redemptions are not what we're seeing a lot of talk of yet, but I expect it. So start looking for it in news articles, headlines, things like that. Just start watching for the R word to start getting bandied about a little bit. There is talk about instead of the Fed stepping down the pace of the hikes or the size of the hikes, now there's talk about a Fed pivot. I know that may sound like, woohoo, yeah, the market's going to go up from that. Maybe not so much. Historically, looking back at the charts, when the Fed has to pivot, usually the outcome is pretty bad for the market. So the idea would be buy the rumor of a pivot, sell the news. We'll know more on the 22nd, of course, since that's FOMC, and they're going to go into blackout period. So keep your eye on that Nick Tamaros guy. Any leaking that they do, they're going to do it through him, right? If they want to communicate between now and then. Also, kind of keep your ear out. They may have an emergency meeting. If you remember down in 2020, everything started to unravel in February of 2020. They had emergency meetings where they just made decisions and let everybody know what the decision was afterwards. I don't think we're there yet, but you know, I wouldn't take it away from them. So right now our current rate is at 450. Going from 450 to 475 is the number one thing on the list here. A week ago, it was a 68% chance. Now it's a 71% chance. Going for a 50 basis point rate hike is 100% off the table at this point. It went from a 40% chance on Friday or on the 10th to 0. And if you guys remember last week, it was sitting in the 60s, 70s. I think it even got into the 80s. No mas. So no 50. 25 is leading the way, but no hike at all is gaining. Well, we can get cute with the language all we want. Did they just pivot for the banks, right? Did they reach down and pull the banks out of their own mud? All we want to focus on here is setting all the politics aside and everything else. What are they going to do with the terminal rate? So for May, let's go out to where the pivot was supposed to be for September. November. It really seems like it's a wrap, right? Like it's a done deal. That the Fed is done hiking. At least that's what's being priced in right now. July 26th still has a little bit of adjustment left, but they made it clear a year and a half ago that they were going to keep raising rates until they solved this inflationary crisis or until they broke something. Well, they finally broke something. So just the main thing with that pivot talk is keep in mind that it's not necessarily going to equate to a market explosion to the upside. We do have additional auctions today. They're really front end. 3-month and 6-month. We have a market maker move of 3% and a 21-day ADR of 1.6. So we're looking at a 4.6% expected move for today. You want to chew on that for a moment. 4.6% expected move for today. A 4.5% move would put us to 40.75. Or 37.25. Now, I've had people ask before, how likely is it that we're actually going to move that far? That maybe I'm just, throwing out some big numbers and trying to just use a little bit of shock and awe, but I'm not pulling these numbers out of a rabbit. It's just math, right? The average daily range is based on 21-day price action. So over the last 21 days, our average daily range has been about 1.6%, and that had been trending down until this new banking crisis. The market maker move, on the other hand, is nothing more than the front end compared to the next series out. So when we're sitting here looking at the options chain, when the front end is higher than the back end, you get a market maker move. And if you want to read more about what a market maker move is and how it's calculated and defined, since it was a phrase developed by Thinkorswim, you can go to the ticker tape and read article after article after article about how they came up with it, how to use it, on and on and on. The volume this morning, the cumulative volume that we track on a day-to-day basis, generally sits between 1 and 200. And this morning we're well above 200. So we have an elevated volume, which is not necessarily connected to everything that's going on. Keep track of the idea that we also have an imminent roll. Thinkorswim has already adjusted the contract. We're on the June series, but there are 4 days left on the March contract. So a lot of that volume has to be associated with the idea that institutions and firms are rolling. The expected move isn't calculated at a set period of time once a day. The expected move is calculated non-stop the entire time that the market is open. So from Sunday night at 6 o'clock all the way until Friday at 4 p.m., it won't stop. Cool. So then when we're looking at it, are we on a 0-day, a 1-day, 2-day, 3-day, 4-day, 5, blah, 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 right? So this is the 1-day expected move. Or I should say today's, not even a 1-day, it's today's expected move. And that would be tomorrow's, a 3-day, 4-day, blah, blah, blah. Now, right now, we are inside day. We were not able to maintain the inside day breakout that we got at the open last night, but we have managed to come back down and reset the market. from where it opened, not yet from where it closed. Now, when it comes to where it closed, there's no good answer for this. Most of the brokers are going to show 4 o'clock, but the futures don't close at 4 o'clock. So it always comes to this argument of, well, which close should I use? The 4 o'clock, the 4:15, or the 5 o'clock? One way that you can just resolve this is to be consistent every single time you do it. And one way to be consistent about marking the close is you can go to a daily chart, and whatever that daily candle close is, that's the close you want to use. It's simple and it solves the problem. This way, you're always consistently marking the same close every single time, and you never have to really worry about it. Unless it's like a holiday, right? Then that screws things up all over again. So we'll just skip that for now and focus on where's the close. We have not closed that gap. We're underneath the weekly pivot point, so we're going to maintain a bearish posture. And we've already hit the daily pivot point, so we don't have an MDP. I'm just kind of taking a peek around here at the other markets. Something just shifted. Now, keep in mind that there's still a lot of threat from Bank of Japan coming up as well, right? So all of that is still on the table. And right now, the global system is kind of having a hard time with it, with everything. So what I'm doing right now is stripping everything off except the VWAP. We'll leave the little labels up there in the corner. They're not hurting anything. Kind of getting a little bit of a feel for what's going on here. Technical analysis always comes with a back seat, so that if crisis events or news comes in, it becomes the dominant factor, and technical analysis is the secondary factor. Without news, then technical analysis kind of rules, right? So it shifts positions, depends on who's leading on the day. We have the president speaking this morning. He could certainly throw some fire into the market that would wipe out any form of price patterns or levels. For a downside move to continue, we first would make the magnet 38, call it 38.80. Then we would want to focus on yesterday's RTH low. There is another pivot though before we get there. It's a voodoo line, but it's also just the Globex low of Friday. So they're kind of overlapping each other. The voodoo line was there first. So on Friday, price came down, hit that voodoo line and came off of it. We overshot through it in price action on Friday, and then we finally broke through it on Friday, gapped over it Sunday night. So it still exists. 38.85. So we got to close this gap. Get through 38.80. We have the ADR full at 38.55, and then yesterday's low at 38.45. We should be fully in the blackout period, so no expectation that any of the Fed members can come in talking, but Yellen can come in and start talking. She's not a part of that blackout period, and in fact, she likes to take advantage of the fact that she's one of the few people who can speak right now, and so she likes to generally, during this blackout period, go out chipping teeth. It wouldn't be surprising at all to hear more from her in the next 10 days. $37.85 is the structural low that we're dealing with right now, and we're in this box. We legged back down into it Friday and then this morning. So it seems that the VIX is woken back up again. I wouldn't be surprised if this continues to increase. Now, a large amount of last year, the VIX was completely worthless, and we might finally start to see a little bit of change there. So if you're looking for maybe a little bit of a hedge, that might be a way to go. This move in crude, that's what got my attention, has made me start looking around at the other markets real quick. We're likely to feel this as the morning wears on. Just don't know which direction it's going to impact the market first. So we're looking for a high correlation coefficient today. We want to see everything start to stack up together, get this divergence across from tech and finance. Yes, my ES is automatically adjusted because I'm on Thinkorswim, and Thinkorswim automatically adjusts. As I mentioned earlier, we're on the June series now, although the March still has 4 days left. Thinkorswim does it automatically. If you're on some other broker, you may have to manually do that roll. All right, 10-day, 30-minute volume profile. We don't necessarily have the classic shape, but we are underneath the point of control, and it's all shallow underneath. So if we do break to the downside, there's no structural levels that we could hit really on the way down. You shouldn't have to click anything for Thinkorswim to automatically roll the contract. It's a default setting. What you might have to do is tell it to do contract change events to like settle the chart. But that shouldn't be a new thing, right? Like you either should be doing that all along, or you've never messed with it and you don't need to. So you can go in and tell it to do settlement changes. I think you can do it through this area, but you can also do it on the chart itself. So go to futures, adjust for contract changes. If you don't do this, see that? So price 39.01, adjust for contract changes, 39.01. Yeah. Consistency is key. If you have never done it, don't do it now. If you've always done it, do it now. You see the line right there, ESM23. So the concern here with the VIX is that it's going to continue to push to the upside. Wouldn't be surprised if we start the cycle back over again, where we start getting above 30. Man, that move in crude is freaking me out. Bitcoin caught some liquidity, and a little bit of this, sure, is a sympathy play, but it doesn't speak enough of it, right? And we've been using this for a liquidity tell. So there's a few odd things to kind of keep your eye on. 10-year breaking down and the S&P not breaking down. That's one. We're starting to see a little bit of a disconnect between stocks and bonds when they were starting to sync up a little bit. So we're breaking that apart again. And gold looking like it's going to do a topside breakout. If we get this breakdown in US dollar Japan, it's very likely we're going to get that breakout in gold as an inverse product. It's exactly what we would expect. So we want to continue to focus on a high correlation coefficient. This move in crude is tying into that deflationary argument and ties into the perspective of the higher VIX. That's a huge move. I know it may not seem like much, but yeah, that's getting a little bit out of control. Well, I started this morning briefing today talking about keep your eye on this wedge. We were very likely going to come out of it. We were at that point where we're getting too close to the end of the apex, right? That something has to break. I just wasn't expecting it to be so violent. Down to 65 this morning in the pre-market on USO. That brings us down to this lower trend line already. Depending on how far back you want to draw your wedge, that's the trend line that held on Thursday and Friday. We've broke that and we're testing this lower one now. All right, so we got some structure at 64. Below 64, we're going to target 62. And if we really start breaking down below that, 59.5, and then 57, and things will really get out of control at that point. We're looking for a high correlation coefficient today. We want to see everything get on the same page. All right, we're very likely going to start to see a little bit of contagion with this move in crude. All right, small caps on IWM have already broken down below yesterday's level. S&P is getting really close to that inside day breakout. NASDAQ still got a long ways to go. So what we're looking at here is the SPY. You can see yesterday's low coming into focus here after this double bottom. The overnight gap is closed. We're below the RTH open, and we are below the Globex low of yesterday. Everything that I'd already mentioned. Now we're focusing on that low of yesterday. Now this will resolve all of the angst about the contract being changed. Did you click the button? Yada, yada, yada. Right? SPY. Remember what I said earlier, if you don't change it, you haven't ever changed it before, don't start doing it now. And if you always change it, well, now's the time to change it. The Qs have the gap closed. Seems to be finding a little bit of stability. This is a part of the correlation coefficient that I was talking about. This dichotomy right now between tech and finance. If everything gets on the same page, then we're going to have a unified market across the board. There won't be a risk on and a risk off and a mid-level sector. There'll just be everything doing one thing. And we got the point of control at 4,000. There's also, if we were to go over to say tier 1 alpha or spot gamma, either one of those, they're going to have 4,000 marked out. And it'll carry something like, well, it'll be, a gamma level, a call wall, a put wall. They got all these levels. With tier 1 alpha, you don't need a subscription, or you don't have to buy a subscription. Let's say it that way. You do have to go get signed up, but they'll send you an email. Simple process. Once a day, you'll get that, and it'll line out what the levels are for you. For spot gamma, not so much, right? You gotta buy that one. So major resistance at 4,000, the pivot level at 3,900, range low 3,800, which is the put wall. Today's 1-day move, 0.89 is the implied move. And the 5-day implied move is 2.5. Volatility trigger is at 4,000. Absolute gamma strike, 4,000. Major resistance, 4,000. Call wall, 4,200. Put wall, 3,800. So 38, 39, 4, 42. All right, last week we hit the VPOC at 39.46, so we can take that one off the table. And we also hit 38.91, so we could take that one off the table. We don't have a VPOC to carry forward from Friday. Thursday, we built a new one, and it's still in play. And that would be at 4,005. Yeah, another 4,000 level. So a break to the upside today. While right now it may not seem, like a high expectation of going up, we absolutely can. If we do make a break to the upside and we get above 39.70, then we have to worry about that VPOC at 4,005. Otherwise, we're going to continue to focus on yesterday's low. And if you're looking at SPY, it's already made that break below yesterday's low. and pulled back up through it. So first blush, that's the first touch play that I've talked about before, right? So it's a nice trade, but it never really feels good to try to trade it. And it has no bearing on the bigger trade, right? Like where we're going to go on the day. It's just a first touch bounce play. It's the expectation that we would get a bounce, a rebound off a major level so that you can get enough points to just be done with it, right? You're not trading back up to the highs or anything like that. You're just trading that rebound. Keep in mind that a classic double bottom is a bear trap. It's what it's designed to do. I'm not saying that this is what's going to unfold here, but when you've got your low and you come back down and you test that low, the way IBD describes it is you want it to go lower than the previous low to trap all the bears. That way, when they run it to the upside, everybody who was a bear and sold to open now has to buy to close, and it adds to the buying, and you get that big explosive move back up the other side. The thing is, when is it a double bottom fake out with a run back to the upside, and when is it just going to continue breaking down and not flip back on you? Grimes covered that a little bit. It's worth looking at, and I'm sure there's something maybe a little more modern than Grimes. I liked his writing style, so I went that route. But watching the tape, measuring out your distal and proximal lines, using supply and demand, all of those would help you determine if this is just a double bottom flip before running back up, or if we're going to continue moving to the downside. It is worth noting that the market maker move on SPY is much smaller. Kind of leads me to believe that the market maker move on the ES, this 3%, now more than 3%, has a little bit to do with the contract situation. You got to remember that all of this isn't a perfect system, and this market maker move is just a formula, right? It's just a calculation on this stuff. I would continue to keep my eye on Bitcoin also. We use it for a proxy for a reason. I'm not talking about trading this thing. We wouldn't trade it unless you're just, I mean, it's an ETF. So, if that's your jam. But the main thing is using it for liquidity, keeping an eye on it as a representation of risk. The KWeb constituents were a little gapped up this morning. They're not keeping it. This would also be, a representation of risk, but more of the emerging market style, right? Like a EEM. Some of the names in the KWeb are also some of the names that are in the NY Fang index, right? That ETF that we use to represent the monsters of tech. So this NY Fang has Baba and Baidu, and I'm not sure who they replaced Twitter with, but Maybe they haven't. Oh, and we should have got the index change too, right? The new names that were going to be added to the S&P, and that should have also happened over the weekend. So tomorrow's CPI data is going to be a really big deal. Normally, if we have CPI on deck tomorrow that we know is a big deal, we would expect today to be a sideways day. Not today. So we got to take that off the table. There's no expectation that we're going to hold the range today and wait for tomorrow's CPI. It's really important to grasp when it comes to VIX and volatility. Yes, this is elevated right now, but it's elevated for a lot of reasons, not just because of the moves in the indexes this morning. So when CPI comes in tomorrow, it's very likely we're going to see some volatility crush. Even if it's bad and the market goes down, we're still likely to see some volatility come out. The absolute gamma strike in SPY is 390 now. And first support is 385 in SPY. That would be yesterday's low, basically. I mean, a little higher than the low, but pretty close. And then 380 for SPY is the put wall. They don't really have a lot of good stuff on SPY below 380. So 380 is going to be the level to really keep your eye on. If you get into the combo, you got 379, 369, and 374. All right, so we found some stability in the 10-year. But bonds aren't slowing down. So the 30-year bonds still running to the upside. We can use something like ZN, ZF. Yeah, still breaking out. we're still looking at an elevated dollar and US dollar Japan about to break below that 133. So got a lot of crazy stuff right now. Kind of everything's broke, right? The correlations that we would look at, the anticipated impact from, a move in the 10-year, it's not hitting the S&P the way that it should. Bonds and stock are decoupling again, which isn't necessarily a bad thing. It's always a little weird when stocks and bonds are moving in the same direction. But this move in the bonds isn't done yet, and that move in crude isn't done yet. It's still going. All right, we're nearly 2.5% below the 10-week. That's not exactly the worst that it's been, but it's pretty low. So we're getting near that level of about the midpoint. Kind of shoot a line across here. Where's the reversals come in at around 4%. It starts to get a little extreme, and then we flip back the other direction. So we're looking for, one of those weeks where we at least get 4% below the 10-week. And for the 10-day, we're 2% below it. That does tie us up in that reversal zone. So if we were only looking at this says, hey, we moved kind of fast. We're getting a little oversold, and we would have an expectation that we're going to flip back and go the other way soon, like a little bit of mean reversion. Now, keep in mind, this doesn't mean we go out and buy long, right? This is it's just looking at the average reversal, how far away from the 10 we normally get before we pause and let that 10 catch up with us, or we turn around and go back the other way, go back towards the 10, or both, right? That we can pause and then go back towards the 10. $147.33 in Apple. We break that, we're going to look to close the gap. Gap close would be 145.91. Still don't see it getting below 144 though. So, a little bit of perspective if you're going to try to take Apple short. Apple's not an easy one to short. Continues to look like we have a reversal opportunity. I was looking back to see if there was anything being said yet coming out of the White House, but Finance Juice isn't posting anything. And there is a speaker today, Bank of England, at 2 o'clock. So 11:30, noon, and 2 for the afternoon, any kind of economic events. So being bearish seems easy enough. Let's kind of flip that over and kind of have that discussion of what would a bullish move look like. So if we back the chart up a little bit to a day that looked like that, right? And in the pre-market, it would have been gapped down. It looks really bearish. It looks like Apple, broke the pivot here and it's headed to the downside. But it's also a TRB. So in the pre-market, it's seriously gapped down. It opens and goes even lower, gets to that 144, flips over, runs back up, fails to break out of the day. It got really close to the open of the previous day, and then it just faded back down again. But the follow through the next day made it back to the top of the range. A TRB is a trend line breakover. It looks like that. There's a trend line, there's a breakover. Happens on any time frame. TRB. So if we back up to this spot where it looked really, really bearish and we were down on the pre-market, we get all the bears sucked in, flip script, run it to the upside. That reversal on the day continued through into this day and continued again into the next day before falling back down again. So now take us to where we are now. If it looks bearish, it feels bearish. Everybody out there, all the news agencies, everybody's talking about how bad it is. And, that move in crude is still freaking me out. But we could see a little bit of a flip here. We're not even going to be opening gapped down yet. Not not down below that previous day's low anyways. So on Apple, look for some stability. See if it's going to try to make another run back up to that 150, maybe 150 half. That would still keep us inside day, right? We would still be inside of Friday's price. So we're looking for a test on the low, maybe an overshoot to 147.25, and then a rally back up. Now, it doesn't owe us a rally, right? I want to make that clear. I'm only looking long because everybody else is looking short. If we break below 147.33, then we're very likely going to just continue the short move. But I wouldn't get all bared up and automatically assume that we're headed down to this 146 and 145, 144. Not unless we start to develop that really high correlation coefficient. And the easiest way to see that is just to go to Market Watch. You go to Market Watch, go to quotes, go to the Visualize tab, and then just change this to your index, right? And they're detachable. So once you've got these set on the day, and unfortunately you have to go in and set them every day. Issues are companies. So you'll have an advanced decline line, advancing and declining, and then you'll have their money flow. When you're looking for a really high correlation coefficient, it's just a really fancy way of saying you want everything moving in the same direction. Not 90 names or 85 names. You want 99 names, all doing the same thing. Now you can put your own watch list in there. You can put in, like your own FANG list, whatever. But Thinkorswim already has pre-built watch lists like the S&P 100, the NASDAQ 100. And since it is 100, you can use everything that you say in a percentage. So if 30 names are down, you can say 30% of the S&P is down. If, 90 names are down, then 90% of the S&P is down. If we're going to see that flip back to the upside today, it's very likely going to be without a high correlation coefficient. But if we continue the move lower, that I believe is where we're going to get everything synced up, right? So for us to break lows, continue to move lower, I think we need a high correlation. But for stability and say like Friday with that sideways choppy holding the line kind of thing, that is a low correlation coefficient. Amazon ain't waiting. It's already on the way to the downside. Broke yesterday's low. It's got support. Nope. It's below that level as well. So we got a gap close on Amazon for now we're below that too. So the gap is closed. That was at 89.87. Below that, we have another gap to close at 86. Tesla's got a gap at 160. And we've got a continuation. You can see on Thursday where we had that gap down, consolidation, breakout, trap, dump, consolidation, rally, double top, held the line, consolidation, topping, and down we go again. Monday looks like Thursday into Friday. So far, it just started the dump early. Like Friday started to dump a little early. So watch the bonds, guys. Keep your eye on those. I don't think the dollar is going to be a lot of help, and the VIX really is starting to wake up. So, getting back into, say, the 30s isn't going to be too much of a surprise. High correlation coefficient, if we're going to continue to move to the downside, the coefficient won't matter if we stabilize or rally. So if this doesn't, start pegging out at 95, 99 names, then we're probably not going to get this big, extreme, drastic move to the downside. Everybody, be careful, be safe, have a good day, and I'll see you all tomorrow.